We all live in a world led by a centralized financial system where everything is controlled by banks and governments. In other words, if you need to transfer or exchange money, you go to a middleman that helps you do that. With the development of cryptocurrency, a new opposing movement has been introduced to the public, a decentralized financial system, or DeFi. This system runs without any central authority to control it. Is this just hype, or is it something bigger than just that? Hey guys, Shad here with the EXMO Cryptocurrency Exchange. Welcome to a new lesson in our cryptocurrency course. And today's topic, as you might have guessed, is DeFi. The DeFi movement aims to create a new financial system that is open to everyone and does not require any intermediaries like banks or other financial institutions to run the exchange and transaction processes. DeFi is built on three core technologies: cryptography, blockchain, and smart contracts. Smart contracts are essentially programs that automate agreement terms between buyers and sellers. Most DeFi projects are built on the Ethereum blockchain. One of the reasons for that is the popularity of Ethereum, but there is also another great reason: solidity. It's Ethereum's robust, Turing-complete programming language that allows anyone to write smart contracts with all the necessary logic to develop DeFi applications. And besides that, Ethereum has already built an ecosystem with thousands of developers building new applications every single day. Now let's take a look at how it all started. MakerDAO was the very first project that started the DeFi movement. It also allows users to lock in collateral like ETH and generate DAI. DAI is a stablecoin that, by using certain incentives, follows the price of the US dollar. So why a stablecoin? DeFi needs to have certain stability to be a reasonable and trusted system, and that's why highly volatile crypto projects can't serve the system. DAI can also be used for saving thanks to MakerDAO's Oasis platform. That's how DAI helps to recreate the first pillar of the financial system: lending and borrowing. Lending and borrowing is actually one of the many DeFi pillars. Others include stablecoins, decentralized exchanges, derivatives, margin trading, insurance, and automated market making. When we're talking about lending and borrowing, we should also mention another great DeFi project, that's Compound. It's an algorithmic protocol with supply assets like Ethereum, BATS, and Tether. Supply assets can work as collateral for borrowing or lending. Therefore, DeFi projects can work as independent, decentralized platforms where you can borrow or lend money, and not through the bank, but directly with another person. Stablecoins are another pillar of DeFi. By using smart contracts and incentives, stablecoins are pegged to real-world money. In most cases, it's the US dollar. DAI is an algorithmic stablecoin that was first introduced to DeFi projects. There are also non-algorithmic stablecoins such as USDT, USDC, BUSD, and others to be a part of the DeFi, but there is a catch: they are generally centralized. In other words, there are companies behind them that hold and back up centralized stablecoins with fiat money. Decentralized exchanges, or DEXs, also play a major role in DeFi. They are the opposite of centralized exchanges and allow for permissionless transactions without giving up custody of the coins. Today, there are two types of DEXs: liquidity-based like Uniswap or Kyber, or order book-based like IDEX or Loopring. So now let's talk about DeFi derivatives. Like real-world finance derivatives, DeFi derivatives are contracts that derive their value from the performance of the underlying asset. You might have heard about Synthetics, the main derivative app in the DeFi ecosystem right now. Margin trading also serves the purposes of DeFi because it involves trading by using borrowed funds and increases the position in a certain asset. Insurance is another part borrowed from traditional finance systems. In general, it guarantees compensation in return for premium services. In DeFi, insurance is provided as protection for smart contracts and deposits. OPIN, a DeFi options trading protocol, serves as a great example of how DeFi projects are protected. It allows users to buy, sell, and create options on ERC20 token standards. So now you know all the pillars of DeFi, let's talk about yet another mechanism that benefits the DeFi ecosystem: oracles. Oracles are reliable apps and services that provide off-chain data to smart contracts from external sources. In other words, they serve as a bridge between the outside world and the blockchains. Data streamed by oracles can come in many forms, such as price feeds, payment information, date of transactions, number of transactions, and so on. Oracles are an important but non-critical part of DeFi. That's why they are not included in the so-called pillars of DeFi. And at the very beginning of our video, I mentioned CeFi, or centralized financial system. CeFi and DeFi are two opposites, so it would be unfair to not compare them. CeFi has permission KYC and sanctions. DeFi is permissionless. CeFi is secure and closed with a code base. Decisions are made behind closed doors. DeFi is open sourced. Its collaboration is welcomed. In CeFi, it can be censored, while DeFi is resistant to censorship. And CeFi works with intermediaries that require expensive fees for their service. DeFi is cheaper, no intermediaries, mostly just network fees. CeFi is built on old foundations, while DeFi is built on a blockchain. And of course, we can't say that CeFi is a bad guy that wants you to pay more money for services, we also can't say that DeFi is a good guy. There are certain risks associated with DeFi services that we just can't avoid. DeFi is essentially a system with smart contracts. These smart contracts might have bugs or they can change their protocols, which will affect transactions, and that's why you need to use insurance services to protect your transactions. The second risk regarded as the level of decentralization of the DeFi project. In other words, what is the shutdown procedure for DeFi? Who controls the admin key? Is it a group of people? Also, there are systematic risks, meaning that if the market experiences a downfall, there will be problems with the liquidation of the assets. And finally, don't forget about network fees. As you can see, DeFi is an interesting space that is full of opportunities. The main DeFi advantages are transparency, interoperability, flexibility. DeFi is still in the early stages of development, but due to its potential, it's likely to get much bigger in the future. Bye for now.